The Rebel Capitalist Show. Yesterday, you emailed me your last report, which was just fascinating. So we're going to kind of walk through that because I think there's so many points that you could hopefully explain for my viewers that they'll really, really enjoy. The first thing, and I'm just going to read right off my notes here, is you talked about the most recent recession being very short-lived and having kind of a V-shaped recovery. And that contradicts a lot of kind of the main, well, not the mainstream thought, but the thoughts and opinions of the majority of the people I interview. So can you explain that? And then I don't know if you could go into that German indicator that you talked about. I found that very fascinating.
Yeah, of course. So firstly, on the economic recovery, what I've been talking about is a short-term V shape, but actually in the sort of like longer run, I'm more looking for like a U shape. And what I've been really talking about as well is a V shape / U shape economic recovery, which still leaves a lot of room for basically a V shape asset recovery. So if we basically focus first on economics, I think there's really two phases to this recession. So there's the one that's basically happening right now, which I've called a flash recession. So it's the deepest, but it's also the shortest on record. The fact is that for the first time in history of earnings, we've had to account for the downgrades straight away, instead of getting a slow drip of downward revisions, looking back at the actual losses. This means that in a matter of weeks, analysts were actually already back to looking for upgrades. So that's really like unprecedented. And we're going to talk about a lot of things that are unprecedented, but for me, that's really what's been driving markets. So in this first economic phase, we had income lost, through loss of employment, which was much more than fully replaced by fiscal programs. And we ended up with a staggering bounce in savings. I think we had the number in savings from like the income report, and I expected like the income to be replaced, but right. What we actually got was like a 33% bounce year on year, which is just amazing. And if you want to share the chart that's in my report with some of your listeners, I'll be happy for you to do so.
Great. But I'll have the editors throw that up right now. Yeah.
I've got the chart at the bottom of the page, and I had to like basically put the whole page.
Yeah.
Savings.
Yeah. It's literally off the charts. Yeah.
Exactly. So in the meantime, we've got businesses that were largely kept on a loan drip and ready to thrive, to be honest, for like the COVID-19 winners. And which one I'm talking about, the Amazon and the Zoom of this world, largely like tech asset class. Yeah. And the ones that are getting ready to reopen for the COVID neutrals. So that's the first phase, really. And if you want to link that into assets, all we've done so far in terms of asset prices is basically revalue those COVID winners and the COVID neutrals in line with much looser fiscal and monetary conditions.
Right.
Now, that doesn't mean that I'm completely like ignoring the second phase of the economic backdrop. The second phase is of much greater concern, and basically the question that we need answered, and which I covered in the report that you read yesterday, but that I intend to look at a lot more in the next few months, is basically what part of these savings will be consumed. And as I said in this week's report, if the consumer, and especially the US consumer, does not consume, he will be losing his job. And that will potentially lead to depressionary trends. But the point is that it's not really the story that we're trading today. And it's something that you need to keep on the radar, but you need to always be trading what's actually happening.
Yeah. So, Juliette, do you think that's the connection point between Main Street and Wall Street? because I think what you're talking about there, it's a lot of the corporations, it's a lot of, the S&P 500, but it's maybe not so much the corner barber shop or the local cafe, something like that. So do you think that the determining factor for Main Street will be what people do with this money they're getting from the government? Are they going to put it into savings? Are they going to pay down debt, or are they going to go out and spend it? Is that it? Am I correct there?
And that's basically the second phase. So the first phase is basically revaluing the COVID winners, the large cap that quite frankly don't have any issues in terms of treasury, and basically the cyclical outlook, which we have started to reprice from last week in line with global economic reopening. Now, you asked me that specific question about the IFO, which is it's a German survey, but for me, it's like the best way to look at what's going on in the world as a coincident indicator. The reason is that it actually surveys like 9,000 businesses in Germany. So we're not talking about analysts, we're talking about businesses here, and that's really the key thing. And obviously, we all know that Germany is massively export-oriented. But what's even more interesting is like Germany's exports are very well aligned with global GDP weight.
Oh, okay.
You look at Germany, you look at what businesses, exporters are thinking about in Germany, and you get a really good correlation between their expectations and earnings growth for the MSCI world. And what I found by looking at the last IFO, which was from last week, is that we've now basically repriced in terms of earnings expectations for next year, so 12-month forward earnings. We're actually now in line with expectations from the IFO survey, which is telling me that the next phase is going to be not about still downgrading, but actually upgrading earnings. And that's really the key thing for the cyclical outlook to brighten a bit, if it's just only in the next few months.
Okay, so is it fair to say that you're actually bullish on the S&P, or is this more Euro-centric? Or I don't want to put words in your mouth.
I'm still bullish stocks generally, but
okay.
I find Europe is just exceptional value. But I think we're going to be going through that, in the rest of the of the questions. Yeah.
And you think Europeans is a better value because they're cheaper right now?
Yeah, much cheaper. When you look at what really drives assets, I mean, there's like a liquidity, but also sentiment. If you can find like an amazing amount of liquidity and an asset that everybody's been hating for the last 10 years, where just 10 days ago everybody was still looking for like a EU breakup and any trades to try and trade the EU breakup, then you will understand why we've actually gone up like 10% in the last 10 days.
Yeah, got it. Okay, so we might be going back a little bit here, but I want to stick with the format. Usually I just ask questions right off the cuff here, but your report was so fascinating. I want to make sure I stay organized. So the next thing that I saw there's you're talking about the growth of an economy having a lot to do with the labor force and then the productivity. And so can you expand on that and why you see that being so important, and then maybe how you see that playing out in the United States, Europe, Japan over the near term and long term?
Yeah. So an economy's potential is basically the growth of the labor force, which, unfortunately, there's not going to be much change to that. Like structurally in the US, we're going to like a growth of the labor force, which is going to continue sliding down to around like 0.5% in the mid 2020s. And you need to add that to productivity levels. So if you look at what the COVID crisis is going to do to the labor force, potentially we'll get a bit less participation. You might have like a skills mismatch between, say, the entertaining sectors, tourism sectors, and that might lower the participation rate. You might also see like some older people that decide finally to retire because they don't want to risk They don't want to take risk on their health, and
Right.
I think we've seen a bit of that, with teachers, and whether it's like in universities or schools. But there isn't going to be that's not really going to be moving the needle much in terms of potential growth.